Good morning and welcome to Retire Smart Austin. My name is Cynthia DeFazio. I am joined today by Phil Capriotti, and Phil is the CEO of Senior Tax Insurance Advisors as well as Donato Wealth Management. Phil, good morning. It's so good to see you again.
Good morning. It's good to be with you again, Cynthia.
Thank you so much. And it's been just amazing, the variety of topics that we covered. But boy, we got a lot of attention last week when we really started to break into annuities. Just there's so many myths around them, and a lot of people maybe feel like there's some negativity as well. To the viewing audience at home, can you kind of explain why there would be a negative connotation with an annuity?
Sure, be happy to. So in addition to there being so many different types of annuities, 5 or 6 different types, you have variable annuities, indexed annuities, fixed indexed annuities, you have lifetime income annuities, fixed annuities, so many of them. Some annuities have market volatility like a variable annuity, and some do not. So one of the disadvantages of an annuity for some folks is that you're in it to win it. You're in it for a long time. Many of these annuities have a stated fixed period of time where you may experience a surrender charge. So for instance, many of the ones that we see have somewhere between a 5-year, 7-year, or 10-year surrender fee. And what that means is if you can take, in Texas, you're allowed to take 10% out a year. This is a 10-10-10 state. We'll get into that later.
Okay.
But you're allowed to take a free withdrawal for up to 10% a year without any penalty against your earnings or your without any penalty against, your earnings or any of the money that you put in. So it's called a free withdrawal. But if you take out in excess of 10%, you'll see a surrender charge. So that surrender charge can range from 9%, and then each year it normally decreases. 9% after your first year, 8, 7, 6, 5 straight over that 10-year surrender period. That's a disadvantage. So the advantage is if you're collecting income or you exercised income in this annuity, you want it in for a long period of time, that's not a problem. But if you want your money liquid, 100% liquid, 100% of the time, then going into a long-term annuity, there would be quite a disadvantage. It would not be the right product for you, and it wouldn't be in your best interest for an advisor to sell you a product of that nature. Most of the, so that would be one disadvantage, okay? One of the other disadvantages with annuities, and I'm referring specifically to fixed indexed annuities now, is they have what's known as moving parts. So what is a moving part? Well, they have these gotchas. My dad used to say there are only 20 nickels in a dollar, son. So if the company is going to invest and work with your money over a 5 or say 10-year period, there's something built into it. The company has to make money too. So let's talk about these moving parts. Many advisors don't fully explain that when you purchase or if you own a fixed indexed annuity, you have an annual cap or a 2-year cap. What that means is, let's say your annuity is indexed to the S&P 500. We'll use that index. Let's assume for a moment that that index grows 20% in the next year. Well, you'll participate in the earnings of that S&P 500, but only up to 3%. That will be your cap or the limit you can make, regardless of what the market does. So this restricts your growth. This is a disadvantage. So when we look at recommending an annuity for a client, we want indexes that have 0 cap. In other words, we want to make more than that 2, 3, or 4%. The other disadvantage or the other moving part in these annuities is they have what's known as a spread. So they'll have no cap, and I've seen salespeople say, yeah, this is a no-cap annuity. You get 100% participation, but they have a spread. And what a spread is when we take a look at the growth of that index, and we'll use the same S&P 500. Well, the spread may be 5%. Well, so the first 5% growth in that index, we get 0% return. So it may have no cap and 100% participation, which we'll get into next. But if the index of the S&P only grows 6%, they'll deduct the 5% from it. That spread will only make 1. So this is also a concern. Some annuities, many of them have both caps and spreads, which really further complicate it. And so what we find is we like to think that all financial advisors, all insurance agents fully explain this to clients, but these annuities should be reviewed at least yearly and for the entire term. When we offer an annuity to a client because it fits into their retirement income plan and it's something that they need, they might need a pension and they might use an annuity, we want to fully explain these moving parts. One of the other moving parts that we see are participation rates. So with a fixed index annuity, you're going to have caps, you may have spread, you may have a participation rate. So many companies offer what's known in our industry as a teaser rate, and these rates are not explained to the clients 90% or more of the time.
Okay.
So what a teaser rate is when you first start out, the spread is very low. It might only be 1% spread. And your participation, that would be the amount of growth you participate in that index's growth, maybe 100%. But on the renewal, after the first year, after the second year, after the third year, the spread will go from 1% to 5%.
Okay.
The participation rate might go from 100% down to 50, down to 20. So what we see, the minimum participation rates with many of these annuities, their minimum is 10%.
Okay.
So let me give you an example, and this is what makes them so confusing.
Okay.
I have no spread in my annuity, and I have no cap, but I only have a 10% participation rate. The market grew, the S&P grew 20% last year. What did I make? Well, I had no spread. I got 100% participation. I had 10% participation, so I received 100% growth. So what did I get? I got 100% of 10%. So if the market or the S&P grew 20%, there's no spread, but I'm only getting 10% participation in that growth with no spread and no cap. I made 2%. So it's extremely important. If you own an annuity, call our office, come in, let us do a comparison analysis. We need to take a look at these annuities, and you need to know, okay, if you're getting ready to buy one, does it have 100% participation for the life of the contract? Or do I have one of these teaser rates?
Yeah.
Am I working with a company that prices that teaser rate in where after year 2 or 3, my returns are going to, or my ability to gain returns in this product is going to be significantly reduced? It's extremely important when you work with a licensed fiduciary, especially someone who recommends an annuity. Again, the priority is very simple. If I won't own it, I won't recommend it.
Phil?
So that should be your acid test.
Hold on to that thought, because we are going to open up the phone lines here in just a couple of seconds. Can you tell the viewing audience what they can expect to receive by being one of the first 10 callers today?
Yes. If you call 888-818-6557, we will provide you with a comprehensive Morningstar portfolio analysis, as well as a comparison benefit analysis if you have one or more annuities. It's extremely important to see what your moving parts are in the annuity. Chances are you have one of these excellent products. There are a handful of them, well, maybe 2 handfuls out of the hundreds that are available. But it's extremely important to understand not just the safety in the product if you have a fixed indexed annuity, but what is your potential for gains? What is your potential for growth?
Absolutely. To the viewing audience at home, that number to call once again is 888-818-6557. We know you have questions about annuities. When we come back, we're going to actually talk a little bit more in detail with Phil. The number again is 888-818-6557. We'll be back momentarily.
Thank you.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only. to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
And welcome back to Retire Smart Austin. My name is Cynthia DeFazio. I am sitting with Phil Capriati. He is the CEO of Senior Tax and Insurance Advisors, as well as Donato Wealth Management. And a great show, Phil, this week about annuities. And we started it last week really getting into the different types and what have you. But people have a lot of questions about these. And I think we should go into this segment, if you will, because people have questions about what kind of fees are involved with annuities. Can you help shed some light on that?
Yeah, we certainly can. So many of these fees, and as we spoke of before, these annuities, especially fixed index annuities, have caps, spreads, and participation rates. Well, in addition to that, many of these products have fees. They'll have mortality fees, which normally range somewhere around anywhere from 0.5% to 1% a year. They also have income rider fees. Many of these products have a guaranteed income rider growth. Many folks confuse income rider growth with actual account value growth, and it's totally different.
Okay.
So the income fees, income rider fees, are normally designed somewhere between 1 to 1.25% per year.
Okay.
So to give you an example of how this can stunt the growth of an annuity, let's assume you're in a fixed index annuity that has 100% participation, but it has a cap of 3% per year. That's normally what the average is nowadays. That's what we're seeing come out with many of these companies. These are the products that they're offering nowadays. Let's assume you have an income rider that provides you with guaranteed income. Once you turn on the income in the annuity or annuitize it, the income rider will guarantee paying you and hopefully your spouse for as long as you live up to age 120. Okay? That income rider, let's say the average cost of the income riders are 1%. We see many of them with 1.25%. So again, I'm an accountant. Let's do the math.
Yeah.
If I have an annuity that's earning 3% a year as a cap, but the income rider on it is 1.25%, regardless of how well the market does, I can only make 1.75% because each year they're going to deduct that fee, that income rider fee, or that mortality fee, or the fee that's internal in that annuity. So it's extremely important when we structure a comparison benefit analysis on an annuity, we want to look at all of the fees.
Okay.
What I like to do with our clients, new and existing clients, is we'll actually, if you're unclear on the fees, they're normally stated right in the contract, but I like to call the insurance company. I'll have my administrators call the insurance company with the client and actually have the insurance company explain each and every fee in their annuity contract, so there are no mistakes.
Okay.
The point is, annuities can be a very good product for certain folks.
Okay.
As long as you understand the product inside, outside.
Yeah.
You have to know, what is my potential for growth?
Sure.
Most folks buy annuities for safety. The sales pitch, so to speak, is when the market drops, you won't lose money in the annuity. That's guaranteed. That's all well and good, but we also want to be able to see growth. Okay? So I not only want income, and with some of these annuities, when we have an annuity, let's assume for a moment I have a person without a pension. and they may have $1 million in their IRA, and they want to put half of it into an annuity, not just for safety, but for guaranteed income. Many of these income riders will not provide increasing income. So we'll see an annuity, it has an income rider, that's great, but we'll start with a certain stated income, let's say $30,000 a year, but 10 years from now, it's still providing them and their spouse with $30,000 a year. There's no increase for inflation.
Sure.
So when we look at an annuity and when a client needs one to replace the fact that they may not have a pension, and they want to take some of their investment and put it into safety, we want to look at an annuity, number one, that has no cap on the growth.
Okay.
Number two, it tracks an index that guarantees 100% participation for the lifetime of the contract, as long as that client owns it. There are no moving parts. And then we also want to add, if we need income, I want an income rider that gives me income or the potential for income increases each and every year so that my annuity can keep pace with inflation while it's earning an average 4, 5, 6% return. Extremely important. When we can put all of those variables together in a product, this is a product that may act in the best interest of the client, not necessarily the best interest of the insurance person or salesperson and or insurance company. It's extremely important. These products are complicated, but they're very simple once you understand them. So when a client comes into our office, we're going to sit down, we're going to have a comprehensive review of their product.
Okay.
Very first thing we're going to ask is, why did you purchase the annuity?
Yeah.
Many times we'll say, a client will say, well, I bought it for safety. Many times we'll look at a client that bought an annuity for income, but they don't need the income. So they might be receiving $35,000, $40,000 a year in Social Security. They may have a pension providing $40,000, $50,000, $60,000 a year. And they have an income annuity that they'll never turn income on. So we'll take a look at it. Does this product really fit into your goals? Is it suitable for you? And if it's not, we can give the appropriate recommendations to help them become more balanced. So if you're purchasing an annuity, make sure that you review it, understand all of the moving parts, make sure you understand how it fits into your retirement income plan. What is your potential for growth? If it's for income, does it give you increasing income? Does it give you 100% spousal increasing income?
Okay.
Does it provide beneficiary benefits to your children and grandchildren if you and your spouse, if you're married, do not collect all of the money out of the income? So the idea behind an annuity is lifetime income, increasing income with no cap on growth and low to no fees. If you put them all together, you have one dynamite annuity product.
Phil, you are just fantastic. We are going to have to take a short commercial break. We're going to open up the phone lines. Can you tell the viewing audience what they can expect to receive by being one of the first 10 callers today?
If you call and you're one of the first 10 callers, dial 888-818-6557. You have my word and my guarantee. Each and every one of you will receive a comprehensive Morningstar review and analysis. If you own an annuity, any type of an annuity, variable annuity, fixed annuity, indexed annuity, income annuity, life annuity, any type of annuity, we will do a professional comprehensive benefit analysis. We want to make sure that this annuity actually acts in your best interest. We want to make sure that you understand what are the benefits, features, and fees, and what is your potential for growth. Come on in, take advantage of our expertise. We'd love to visit with you. We'd love to help you.
Thank you, Phil. The phone lines are already lighting up. That number to call once again is 888-818-6557. We do have to take a very short commercial break, but we'll be back momentarily with more questions and answers about planning your perfect retirement. Please stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to Retire Smart Austin. My name is Cynthia DeFazio. I am joined today by Phil Capriati. He is the CEO of Senior Tax and Insurance Advisors as well as Donato Wealth Management.
Good to be here.
What an amazing plethora of information regarding annuities. And I love when you were talking on the show, I was watching the phone lines light up. That's how we know we're piquing interest in our viewing audience. And I love that about our show. So if you don't mind me asking, Phil, there was a lady who called in. She has a question about her variable annuity. To the viewing audience at home, can you explain what that is, a variable annuity?
Yeah, so a variable annuity is actually an investment product inside of an insurance contract.
Okay.
All right, so that's a mouthful,
I was like, okay.
Right? Okay. So the way a variable annuity is, ma'am, think of a variable, right? So it goes up and down. It's not fixed, it's not indexed, it's variable.
Okay.
When the market goes up, you're depending on the sub-accounts, or we call them, they're kind of like mutual funds, they call them sub-accounts. Inside, based on the sub-accounts that you're in, they may go up with the market, they may go down with the market. Now with the variable annuities, some of them have income riders, some of them have high water marks. We'll talk about that in a little bit. A high water mark is where you can lock in a certain rate, and normally they give you once a year, you can lock in a rate, so if the market does drop, you will not experience significant losses. Many folks will come in with a variable annuity that have a high watermark feature, but the representative never calls them or advises them when to lock it in based on things, events that are going on in the market. But let's just stick to the basics. Variable annuities, in my professional opinion, are really becoming obsolete. With the rollout of ETFs and mutual funds and actively managed mutual funds, a variable annuity is designed to get market growth and tax deferral. So we want market growth, but we don't want to pay the taxes on the accumulation until we take the money out and spend it. This is probably one of the primary benefits of any annuity product. It defers taxes for when we want to take the money out. With a variable annuity, what we see many times with a variable annuity is most folks don't realize all of the fees that are associated with a variable annuity. So you'll have mortality charges. Many of those range about 85 basis points, just short of 1% a year. You have administration charges. You have sub-account charges. You have, you also have, in addition to that, you have income rider charges. Many times with a variable annuity, the client is unsure of the charges, and this is why we'll call the insurance company, we'll talk with them. I know them, but I want the client to know them. It's their product. They bought it from another advisor. Many times with a variable annuity, the internal fees range anywhere from 2.5% to sometimes upwards of 3.5% per year in annual fees that are deducted from the growth of the index or the growth of the sub-accounts. In addition to that, if it doesn't have an income rider, when we see a COVID-19 situation, we see the market dropped 31% within a stated period of time, or whatever percent, depending on your portfolio, your annuity is going to drop that amount. So now when we're looking at a variable annuity inside of a retirement plan, many times between taking income from the annuity excessive, what we consider excessive fees, averaging 3% a year, plus market volatility, many of these annuities can literally collapse over a 10, 15, 20-year period.
Okay.
If you're collecting lifetime income, great. If it's not increasing income, if it's static income, not so great, in my professional opinion.
Okay.
So we want to take a look at understanding your product. Come in for a comprehensive comparative analysis. We'll call the company with you. My staff is trained to ask the right questions so that if you do not fully understand your product, guaranteed by the time you leave our office after our consultation, you will understand your product. Many times we'll even call the advisor that sold the product with the client just to kind of get them involved as well. There's never anything wrong for that, especially if the client does not know why they even purchased the annuity. And I would say more times than not, that's normally the case.
Sure.
So what type of annuity? Extremely important. Does it fit into my overall retirement plan? Very important. Is it tax efficient? Can I turn the income on and off? If I have an income annuity, is my income static? Will it stay the same after a 5, 10, 20-year period? Or will it increase with inflation or with market growth? What are the fees?
Yeah.
Do I have volatility in it? Is there a cap in my annuity? What is my participation rate? What is the spread? All of these questions need to be answered, and this is what you can depend on when you call 888-818-6557. It's a call to action. These insurance products are extremely important. Sometimes they'll fit into your portfolio, sometimes they won't. If you own an annuity, it's extremely important to understand whether this product acts in your best interest or if it was in the best interest of the salesperson that actually sold it to you. We need to take a careful look at that, and we also want to make sure that these products are not going to cause you a potential tax issue later.
Sure.
We want to make sure if you own an annuity, do you really need one?
Yeah.
Or did you purchase it for income? So annuities, extremely complicated. That's why they sometimes get a very bad rap, so to speak. But some of these annuities are excellent products. Again, if I won't own it, I won't recommend it. And that's what all, as far as I'm concerned, with all financial advisors, that should be the asset test. If I won't buy it, if I won't own it, I shouldn't recommend it. That's what a true fiduciary does for a client.
Absolutely. And Phil, I think everyone in the viewing audience can agree that you definitely are so passionate about this topic. You are the person to talk to. And it's time for us to end another show this week. To the viewing audience at home, thank you so much for tuning in. We know you have questions about retirement. Annuities, of course, is just one small part of that, but Phil is able to help. That number is 888-818-6557. Thank you so much for watching. We will see you again next week. Be safe.
God bless. Thank you, Cynthia.
Thank you, Phil.